Millennials, the generation that came of age after the turn of the millennium, are facing a financial landscape unlike any generation before them. Saddled with student loan debt, stagnant wages, and rising living costs, many millennials find themselves struggling to make ends meet. The American dream of home ownership, once a given for previous generations, feels like a distant aspiration for many. Financial insecurity casts a long shadow, impacting not just material well-being, but also mental and emotional health. The stress of living paycheck to paycheck, coupled with the uncertainty of the future, can feel overwhelming. It's no wonder that millennials are often labeled the anxious generation. But there is hope. Financial literacy, the ability to understand and effectively manage one's finances, is a powerful tool that can empower millennials to take control of their money and build a more secure future. While the challenges are real, they are not insurmountable. This essay serves as a guide to help millennials navigate the complex world of personal finance. We'll break down essential financial concepts into actionable steps, providing practical tips and strategies to help you master your money. A budget is more than just a spreadsheet or a financial app. It's a roadmap to your financial goals, a tool that empowers you to make conscious decisions about your money. Without a budget, it's easy to lose track of where your money is going and find yourself struggling to make ends meet. The beauty of a budget is its simplicity. It doesn't require complex formulas or financial jargon. At its core, a budget is simply a plan for how you will allocate your income each month. It's about making sure your money is working for you, not against you. Creating a budget may seem daunting at first, but it's a skill that gets easier with practice. Like any good roadmap, a budget needs a starting point. In this case, your income is that starting point. In the next section, we'll dive into the first step of creating your budget, identifying your income sources. By understanding where your money comes from, you can begin to make informed decisions about where it should go. Remember, taking control of your finances starts with understanding the basics. Before you can start allocating funds, you need to know how much money you have coming in each month. This involves identifying all your sources of income. Start with the most obvious, your salary. If you receive a regular paycheck, note down your net income, which is the amount you receive after taxes and other deductions. Don't stop there. Consider any additional income streams you may have. Do you have a side hustle, such as freelance work, driving for a ride-sharing service, or selling handmade goods online? Include these income sources in your budget as well. It's also important to factor in any irregular income you receive. This could include bonuses, tax refunds, or gifts from family members. While you may not want to rely on these sources of income for everyday expenses, it's helpful to track them so you can adjust your budget accordingly. Once you have a clear picture of your total monthly income, you can move on to the next step: tracking your expenses. This is where the real work of budgeting begins. But it's also where you can start to identify areas where you can save money and make your money stretch further. Now that you have a handle on your income, it's time to turn your attention to where your money is going each month. This is where many people find themselves struggling, as it's easy to underestimate how much we spend on everyday expenses. The key to effective expense tracking is to be thorough and honest with yourself. Start by gathering your bank statements, credit card bills, and any receipts you've accumulated over the past month. Go through each item and categorize your spending. Common expense categories include housing, transportation, food, utilities, healthcare, entertainment, and debt payments. You can create subcategories within each category to get a more detailed view of your spending habits. As you track your expenses, you'll likely be surprised by some of your spending patterns. You might discover that you're spending more on takeout coffee than you realized, or that your monthly subscription services are eating up a bigger chunk of your income than you thought. This awareness is crucial, as it allows you to make informed decisions about where you can cut back. With your income and expenses clearly mapped out, you're ready to start building your budget. But before you start allocating funds, it's important to consider your financial goals. What do you want to achieve with your money? Do you dream of buying a home, paying off student loans, or retiring early? Your financial goals will shape your budget and help you stay motivated to stick to it. Write down your short-term and long-term financial goals and prioritize them. Once you have a clear understanding of your financial aspirations, you can start allocating your income accordingly. Begin by covering your essential expenses, such as housing, food, and transportation. Then allocate funds towards your debt payments and savings goals. The amount you allocate to each category will depend on your individual circumstances and financial priorities. If you have a lot of high-interest debt, you may need to allocate more funds towards debt repayment. If you're saving for a down payment on a house, you'll need to prioritize saving. An emergency fund is your financial safety net, designed to cover unexpected expenses such as medical bills, car repairs, or job loss. It should ideally cover 3 to 6 months of living expenses, providing you with a buffer that can prevent financial distress during hard times. The first step in building an emergency fund is to determine how much you need to save. Calculate your monthly living expenses. Include rent, utilities, food, and any other regular expenses. Multiply this figure by the number of months you want your emergency fund to cover. This is your target. Start small if a large fund seems daunting. Even saving a small portion of your income, such as $50 or $100 a month, can slowly build up to a substantial amount. The key is consistency. Make saving for your emergency fund a regular part of your budget. Consider keeping your emergency fund in a separate savings account to avoid the temptation to spend it. Look for an account with no fees and easy access. Remember, the purpose of this fund is availability in emergencies, not investment. Automating your savings can significantly enhance your ability to save without thinking about it. By setting up automatic transfers from your checking account to your savings account, you ensure that a portion of your income is saved before you have a chance to spend it. Start by deciding how much you want to save each month. It could be a percentage of your income or a fixed dollar amount. Then set up an automatic transfer for the day after your paycheck is deposited. This reduces the temptation to spend what you plan to save. Automating savings helps in building disciplined saving habits. Over time, these automated deposits can grow into a significant nest egg, contributing to your financial goals without additional effort on your part. Also consider automating contributions to retirement accounts or investment plans. Many employers offer the option to automatically divert a portion of your salary to a 401k or similar retirement plan, often with matching contributions. A high-yield savings account is an excellent tool for millennials who want to earn more from their savings. Unlike traditional savings accounts, high-yield accounts offer superior interest rates, which can help your savings grow faster. To start, shop around for the best interest rates. Online banks often offer higher rates than traditional brick-and-mortar banks because they have lower overhead costs. However, ensure the bank is FDIC insured to protect your money up to the legal limit. Once you select a high-yield savings account, consider transferring your emergency fund or other savings into this account. The higher interest rate will compound over time, increasing your savings without any additional effort. Remember, while the interest from a high-yield savings account won't make you rich, it can significantly accelerate your savings goals compared to a standard account, especially when combined with regular deposits and sound financial habits. Saving for specific financial goals, whether it's a down payment on a house, a dream vacation, or starting a business, requires targeted strategies. By setting clear goals, you can determine how much you need to save and how long it will take. Begin by defining each goal and estimating how much money you'll need. Then, set a deadline for each goal. This timeline will help you calculate how much you need to save each month. Use separate savings accounts for each goal to keep track of your progress and avoid mixing funds. Consider automating deposits into these accounts, just as you would for your general savings. This ensures consistent savings contributions and helps you reach your goals faster. For larger long-term goals, consider investing to grow your savings. Investments can yield higher returns than regular savings accounts, but be sure to assess the risk and your comfort level with potential fluctuations in investment value. Smart spending isn't about depriving yourself. It's about making intentional choices with your money. One of the biggest obstacles to smart spending is the impulse buy, that sudden urge to purchase something you hadn't planned for. These unplanned purchases can derail your budget and leave you wondering where your money went. The next time you feel the pull of an impulse buy, take a moment to pause. Ask yourself if you genuinely need the item or if it's simply a fleeting desire. Often, the urge to splurge will pass if you give yourself a little time to think it over. Another effective tactic is to create a shopping list before you head out to the store or browse online. Sticking to your list helps you stay focused on your planned purchases and avoid being swayed by tempting displays or online ads. Remember, delaying gratification can be a powerful tool. If you still find yourself thinking about the item after a few days, you can always reconsider. But chances are, you'll be glad you resisted the initial urge and saved your money for something more important. Section 2. Cashback and rewards programs. Your allies in saving. In the world of personal finance, cashback and rewards programs are like getting paid to shop. By utilizing credit cards strategically and taking advantage of loyalty programs, you can earn money back on your everyday purchases. It's a simple yet effective way to stretch your budget further. When choosing a cashback credit card, look for one that aligns with your spending habits. Some cards offer higher cashback rates on specific categories like groceries, gas, or dining. Others provide a flat cashback percentage on all purchases. Be sure to read the fine print and understand the terms and conditions of any cashback or rewards program. Pay attention to annual fees, interest rates, and reward redemption options. Remember, responsible credit card use is key. Treat your credit card like a debit card, spending only what you can afford to pay back in full each month. This way, you can reap the benefits of cashback and rewards without incurring high interest charges. In today's digital age, finding deals and discounts is easier than ever. From online coupon codes to price comparison apps, a plethora of resources are at your fingertips, ready to help you save money on everyday purchases. Before you make a purchase, take a few minutes to search for discount codes or coupons. Websites and browser extensions specialize in aggregating these deals, making it simple to find the best price. Price comparison websites and apps are also invaluable tools for savvy shoppers. These platforms allow you to compare prices from multiple retailers simultaneously, ensuring you get the best possible deal. Don't forget to check for student discounts, senior discounts, or discounts offered through your employer or membership organizations. These often overlooked savings can add up significantly over time. Investing can seem intimidating, especially for millennials who are just starting their financial journey. But the truth is, investing is simply about putting your money to work for you, allowing it to grow over time and build wealth. Think of it as planting seeds for your future financial security. The earlier you start investing, the more time your money has to grow. Even small amounts invested consistently can accumulate significant value over the long term, thanks to the power of compound interest. Compound interest is like earning interest on your interest, creating a snowball effect that accelerates your wealth-building journey. There are numerous investment options available, each with its own level of risk and potential return. Stocks, bonds, and mutual funds are some of the most common investment vehicles. It's important to research and understand the basics of each investment type before putting your hard-earned money at stake. Remember, investing isn't about getting rich quick. It's a long-term game that requires patience, discipline, and a sound investment strategy. By starting early and making informed investment decisions, you can pave the way for a financially secure future. Diversification is a fundamental principle of investing, often referred to as not putting all your eggs in one basket. It involves spreading your investment across different asset classes, such as stocks, bonds, and real estate, to reduce risk and potentially enhance returns. The idea behind diversification is simple. If one investment performs poorly, the others can help cushion the blow. Different asset classes tend to perform differently under various market conditions. For example, when stocks are down, bonds may hold their value or even increase in price, providing stability to your portfolio. There are various ways to diversify your portfolio. You can invest in individual stocks and bonds or opt for mutual funds and exchange-traded funds, ETFs, which offer instant diversification by holding a basket of different securities. Remember, diversification is an ongoing process. As your financial situation, risk tolerance, and investment goals change, you'll need to rebalance your portfolio periodically to maintain the desired asset allocation. Robo-advisors have emerged as a popular investment tool, particularly for millennials who are comfortable with technology and prefer a hands-off approach to investing. These digital platforms use algorithms to create and manage investment portfolios based on your financial goals, risk tolerance, and time horizon. One of the key advantages of robo-advisors is their accessibility. They typically require lower minimum investments compared to traditional financial advisors, making them an attractive option for beginners. They also charge lower fees, which can significantly impact your investment returns over time. Robo-advisors take the guesswork out of investing. After you answer a series of questions about your financial situation and investment goals, the platform's algorithm will recommend a diversified portfolio tailored to your needs. The platform then automatically manages your investments, rebalancing them periodically to stay on track. While robo-advisors offer a convenient and cost-effective way to invest, it's important to research and compare different platforms before making a decision. Consider factors such as fees, investment options, and the platform's user interface. Retirement may seem like a lifetime away, but it's never too early to start planning for your financial future. Retirement accounts such as 401, KKS, and individual retirement accounts, IRAs, offer tax advantages and can help you accumulate a substantial nest egg for your golden years. A 401(k) is an employer-sponsored retirement savings plan that allows you to contribute pre-tax dollars, reducing your taxable income. Many employers also offer matching contributions, essentially free money that can significantly boost your retirement savings. IRAs are individual retirement accounts that offer tax advantages for retirement savings. Traditional IRAs allow pre-tax contributions, while Roth IRAs use after-tax dollars but offer tax-free withdrawals in retirement. The power of compound interest is especially evident when it comes to retirement savings. The earlier you start contributing to these accounts, even with small amounts, the more time your money has to grow, potentially allowing you to enjoy a comfortable and financially secure retirement. Debt can feel like a heavy weight, holding you back from achieving your financial goals. It's a common challenge, but it's not insurmountable. The first step to managing debt is acknowledging its impact on your financial well-being. Debt payments eat into your monthly income, leaving you with less money to save, invest, or spend on things you enjoy. High-interest debt, such as credit card debt, can quickly spiral out of control if left unchecked, accruing interest charges that add up over time. The good news is that you can take control of your debt and work towards becoming debt-free. It starts with understanding the different types of debt you have and developing a strategic plan to pay them off. In the following sections, we'll explore effective strategies for managing debt, including prioritizing high-interest debt and utilizing debt repayment methods, such as the debt snowball and debt avalanche. Remember, becoming debt-free is a journey that requires commitment and discipline, but the financial freedom you'll gain is well worth the effort. When it comes to debt repayment, not all debts are created equal. High-interest debt, such as credit card debt, can quickly erode your financial progress, accruing interest charges that can make it feel like you're stuck in a never-ending cycle of payments. The first step in tackling your debt is to identify your high-interest debts. These are the debts that are costing you the most money in interest charges each month. Make a list of all your debts, including the outstanding balance and interest rate for each. Once you have a clear picture of your debt landscape, prioritize paying down your high-interest debts first. While it's important to make timely payments on all your debts, focusing on high-interest debts will save you money in the long run. Consider using the debt snowball or debt avalanche method, which we'll discuss in the next section, to help you stay motivated and on track with your debt repayment goals. Remember, every dollar you pay towards high-interest debt is a dollar less that goes towards interest charges, bringing you closer to financial freedom. The debt snowball and debt avalanche are two popular debt repayment methods, each with its own unique approach. The debt snowball method focuses on building momentum by paying off the smallest debts first, regardless of interest rate. The debt avalanche method, on the other hand, prioritizes paying down the debts with the highest interest rates first. The debt snowball method can be highly motivating, especially if you're feeling overwhelmed by debt. Seeing quick wins early on can give you the psychological boost you need to stay committed to your debt repayment journey. As you pay off each small debt, you free up more money to put towards your larger debts, creating a snowball effect. The debt avalanche method, while not as immediately gratifying as the debt snowball, is mathematically more efficient. By tackling your highest interest debts first, you minimize the total amount of interest you pay over the life of your debts. The best debt repayment method for you depends on your personality and financial situation. If you're motivated by quick wins, the debt snowball method might be a good fit. If you prefer to save money on interest charges, the debt avalanche method might be a better choice. Regardless of which method you choose, the key is to stay consistent and committed to your debt repayment goals. In today's digital age, managing your finances has never been easier, thanks to a plethora of budgeting apps designed to simplify and streamline your financial life. These apps act as your digital financial assistant, providing real-time insights into your spending habits and empowering you to make informed decisions about your money. Gone are the days of manually tracking expenses in a spreadsheet. Budgeting apps connect directly to your bank accounts and credit cards, automatically categorizing your transactions and providing you with a comprehensive view of your cash flow. You can set spending limits for different categories, receive alerts when you're approaching your limits, and track your progress towards your financial goals. Many budgeting apps also offer additional features, such as bill payment reminders, savings goal trackers, and investment monitoring tools. Some apps even use artificial intelligence to provide personalized financial advice and insights based on your spending patterns. Choosing the right budgeting app for you depends on your individual needs and preferences. Some popular options include Mint, YNAB, You Need a Budget, and Personal Capital. Experiment with different apps to find one that aligns with your financial goals and helps you stay on track. While budgeting apps and online resources can provide valuable financial insights, sometimes it's helpful to seek personalized guidance from a qualified financial advisor. A financial advisor can provide expert advice tailored to your specific financial situation, goals, and risk tolerance. Financial advisors can help you with a wide range of financial planning needs, including budgeting, saving, investing, retirement planning, estate planning, and insurance. They can also provide guidance on complex financial matters, such as tax optimization and debt management. When choosing a financial advisor, it's essential to look for someone who is trustworthy, experienced, and holds the necessary certifications. Fee-only financial advisors, who charge a flat fee for their services rather than earning commissions on products they sell, can provide unbiased advice. Remember, a financial advisor is a partner in your financial journey. It's crucial to communicate openly and honestly about your financial situation, goals, and any concerns you may have. The internet is a treasure trove of free financial education resources, providing millennials with ample opportunities to expand their financial literacy and make informed decisions about their money. From blogs and podcasts to online courses and webinars, there's a wealth of information available at your fingertips. Reputable financial websites, such as those of government agencies, nonprofit organizations, and financial institutions, offer a wealth of unbiased information on various financial topics. You can find articles, guides, calculators, and tools to help you with budgeting, saving, investing, and more. Financial blogs and podcasts hosted by financial experts and enthusiasts provide insights, tips, and strategies for managing your money effectively. Many offer personal finance advice tailored to millennials, addressing common challenges such as student loan debt, saving for a down payment on a home, and investing for the future. Online courses and webinars offered by universities, financial institutions, and online learning platforms can provide a more structured approach to financial education. These courses cover a wide range of topics, from basic financial concepts to advanced investment strategies. Throughout this essay, we've journeyed through the essential building blocks of personal finance, equipping you with the knowledge and tools to master your money. We've explored the importance of budgeting, the power of saving, the art of smart spending, and the significance of investing for the future. We've learned that financial freedom isn't about amassing wealth. It's about having control over your financial well-being. It's about making conscious choices that align with your values and goals, freeing yourself from the burden of debt and the stress of financial insecurity. The road to financial freedom is a marathon, not a sprint. It requires patience, discipline, and a willingness to learn and adapt. There will be bumps along the way, unexpected expenses, market fluctuations, and moments of doubt. But by staying focused on your goals and implementing the strategies outlined in this essay, you can navigate these challenges and stay on track. Remember, financial literacy is an ongoing journey. As your life evolves, your income changes, you start a family, you approach retirement. Your financial needs and goals will also evolve. Embrace this journey of continuous learning, seeking out new information and resources as needed. The first step is often the hardest, but it's also the most important. Don't wait for the perfect time to take control of your finances. The perfect time is now. Start by implementing one or two of the strategies we've discussed. Create a budget, automate your savings, pay off a small debt. As you experience the positive impact of these small steps, you'll gain the momentum and confidence to tackle bigger financial goals. Celebrate your successes along the way, no matter how small they may seem. Every step forward is a victory. Remember, you're not alone on this journey. Countless resources are available to support you: financial advisors, online communities, and educational materials. Don't hesitate to seek help when you need it. The power to shape your financial future is in your hands. Embrace